Okay, I want to say welcome and good morning to everyone for Chinese equity market tutorial. We are now in week number 4. Can you all hear me at the back? Yeah. Wentao, you can hear me? You can hear me clearly. Okay, we seem to be a little bit short of people, but that's okay. I actually have many interesting things I want to share with you today. The session will be recorded. Not all of them will be recorded, so it really depends. Either if the content is unusually complex, and last week was probably a good example, or some people are, if they are requesting it because they need to be absent for compelling reason. Otherwise, don't assume that they will always be recorded. Okay, and it's not really a good use of your time to go home and spend another hour and a half unless you really have to. But so today I actually want to go through a few things with you. These are all topics that Paul McGuinness has touched upon, maybe except the last one on bonus issues and scrip dividends. He might do that next time. Versus stock splits. I'll talk a little bit about the idea of oversubscription in an IPO and what it really means, and also cornerstone investors. I actually wanted to share with you some notes regarding weighted voting rights as well. I haven't put that down here, but I have made some slides on that. Can you still see? Not really. Let's see if it's gonna. So, like I said, I've also made some. I want to share with you some comments regarding the topic of weighted voting rights, which Paul also touched upon. So all of these topics are, very useful and interesting discussions of these issues, but more from a commercial, from a practical point of view as well. Okay. Now I'm going to start so here is our calendar, and we have already done this and this and this. We've done that. So you guys are T1. We did this last week. When a date looks a bit funny, so this one is in a different color, and it has an underline. If you go in there, I have not uploaded this file yet, but when it's ready, if you click on the date, it will take you to a video recording of that tutorial. Okay, if there was a recording, this one was recorded last week with you guys, and I did that because some of you were a bit confused by green shoe. Okay, so I hope that will be useful. I hope that was useful for your assignment number 1, your take-home assignment, as well as, well, when you do your final exam, I think it will be relevant. Okay, and so that's on the videos, and then so today we are here. Everyone had a good weekend? Why? What did you do? Did you go and see the fireworks? Anyone? No. Assignment. Yeah, there'll be fireworks in your assignment. All right, so just a note on next Monday. So I know we meet on Monday at 6:30. For next week, I may have to start a little bit early, if that is okay with you guys, and might just finish a little bit early. Okay, I have a family occasion I need to go to. In fact, it's a dinner. Okay, somebody from overseas. It's my brother actually. Actually, it's none of your problems. It's my problem. I'm away from home 4 nights a week out of 7, and even little things like dinner or uh, going to a parents' meeting at my son's school becomes a logistical challenge this term for me. So I hope you can understand. So next week, I will give you a further confirmation. Do you have anything on Monday afternoon? Anybody? So even if we were to start at 6, you'll be okay, would you? I would that would really help me a lot. Um, so, but let's see, okay? Um, so like I said, if you have problems, I will probably try to augment that with a video. Now, housekeeping, what's new? Not much, except that next Monday the lecture might be earlier, okay? Assignment number 2, I suspect Paul will give it to you either this weekend or next weekend, and then he normally will give you 2 weeks to do it. So I say do at the start of lecture, October, I don't know when, not yet. Okay. So thank you everyone for handing it in on time last week. We really appreciate that. And it's important you give it to us actually at the beginning of the lecture. Okay. Now, I want to start today with a question, okay? And have you all got your mobile phones or your laptop? If you don't, actually, there's a computer right in front of you. So can you please go to, okay, I'll tell you what, let's have a bit of fun, okay? Because I really want to know how you guys think. And I'm going to go to, so get out your either your laptop or your mobile phone, or if either fails, just log on to the computer in front of you. Okay, try to get on the internet, in other words. Okay, try to get on the internet somehow. I'm going to do a quick survey, and I'm going to use, what's that thing called? You reply. And what you need to do is, I'm going to ask you a question which only requires a yes or no answer. And you need to go to, I don't know why the QR code is partly blocked, but just go to https ureply.mobi. Now you need to punch in a session number 15011. Okay, I don't mind you don't put your real name, or I'm not concerned with the identity. Just put whatever you want. Okay. Oh, what happened? Okay. Did we just lose it? I didn't know we lost the signal. Okay, so https:// so I didn't know we lost the signal. Okay. ureply.mobi. Don't answer the question yet. You don't know what the question is. Are you able to do that? The session number is 15011. Everyone is okay? Please feel free to participate. And like I said, you don't have to put your real name. You can. I'm not even going to check it. Okay. But I do want everyone to sign on. We're going to take a vote on this. Okay. We've got 17 people signed on. 18. And the people not here. We got 20 people. All right. So while we are waiting for the other two, now this is a yes and no question, and I only got one question. So, someone already answered. All right. Well, never mind. You can go out and come back. Okay. Now the question is simply. So I'm going to ask you two questions. I have to do this, and then start the session again. Sorry about that. The question is, question 1. Do you think weighted voting rights is good for stock issuers? Now, question 2, I will ask you late in a moment. So if you think it is good for stock issuers, question 1, just click on yes. If you think it is not, just click on no. Okay? Very simple question. Now, I know I have not really I haven't said anything about weighted voting rights, and I'm doing that on purpose. You might not even know fully, you might not even fully understand what it is, okay? It's fine. I'm going to take a vote at the start. We're going to talk about it, and I want to take a vote at the end and see if there are any differences, okay? So question 1, let's see. So 17 people have responded. 18, 19, 2 more. The other 2 are okay, or you don't know what to press. You haven't made up your mind. All right. Are there 2 others who haven't casted their vote? 22. We've only got 20 people here. Okay. All right. Never mind. Okay. N. So let's see. So weighted voting rights good for stock issuer? Answer A is yes. B is no. So actually, it's overwhelmingly considered to be good for stock issuers. Okay, next. I'm going to now obviously ask you question 2. And the question 2 is simply, do you think weighted voting rights is good for stock investors? Okay, so you can okay. Session info. You actually, looks like you can use the same session, and just click yes or no. Okay. do you think WVR is good for investors? I want to share with you some info on this because I can see that topic coming up actually in career interview situations where you may be asked a question. Now, maybe the managers or the employers, they don't expect you to even know what it is or what the issues are. But if you do, you are going to stand out in the crowd. Okay, that's my intention. Okay, we got 3 more. Anyone hasn't voted yet? Okay, all right, thank you. Okay, end. Okay, now, so for really are no pens. All right, so the vote is 57, 52. 57 plus 52 is 109. Oh, where that came from. But never mind, it's roughly half and half, okay? So this is like 90-10. This is like half and half. Okay, I'll put 57, 52. Never mind. And this is before. Okay, now I'll tell you a bit more about this in just a moment. It's okay if you don't completely understand. First, let me go to, and I'm taking Paul McGinnis' instructions. He asked me to just take a quick look at not assignments. One of the notes that he put out on stock reorganization. Now, did you all have a chance to look at this? This should already be on Blackboard. He uploads his stuff by himself. Have you had a chance to see this? Okay, now you should pay some attention to this. This is really looking at what's called a stock split, primarily from an accounting point of view. Now, stock splits, as you should know, is when a company that may have, 1,000 ordinary shares suddenly decide to split them into a higher number. In this case, so we pretend that there's a company called CDE which has got 1,000 million shares, and there's a par value of 30 cents per share, and they decided to do a stock split of 1 for 3, so every 1 share becomes 3 shares, and and the accounting process. The first thing I want to say actually is that when you are doing stock splits or reverse stock splits, stock merge or whatever you want to call it, I think they're called reverse stock splits. So stock splits is when 1 share splits into several. It can be 2, 3, 4, 5, 6, okay? A reverse stock splits is when you actually kind of merge. So you may have 3 shares before and 3 shares become 1 share, okay? the first thing I would say is that, and I think we briefly touched on this last time. Now, by themselves, a simple stock split exercise should not really create any kind of economic value whatsoever, okay? To the extent that the so now we are week 4. To the extent that the value of a company is equal to the price multiplied by the number of shares, then a stock split does not create any value or change the valuation. Then as the number of shares goes up, the price surely will come down, and that is what you see. But it's curious that sometimes they don't go up or down by exactly the same amount. So in this case, the price of the stock was 30 cents, and there's 1,000 shares, 1,000 million, but I'll just ignore the million. And then the stock splits will split them into 3,000 shares. You would expect that the stock price will adjust to just this one, okay? But sometimes it wouldn't be exactly that in the real market. And the reason for that normally is, the reason is to do with the reason behind the stock splits often, which is, okay, why do people do stock splits? Well, you take a look at something like Amazon, okay, or even Google. Amazon is the best example I can think of. So right now, one share of Amazon is actually $2,000. That's US dollars, okay, one share. Now, in the US market, they trade in standard lot size. Standard lot size, okay? 一手. Do you know what is the standard lot size in the US? 100 shares. Is that the same in China? It is. Okay, that's good. In Hong Kong, it isn't, which means depending on which company you're looking at, the lot size is all over the place, okay? HSBC, for instance, is 400 shares, okay? Some other companies, the number can be bigger, can be smaller. I don't like that. Actually, 100 is good because that makes it very simple for option hedging. We'll come on to that maybe next term when we talk about that, okay? But so I much prefer this idea. So you know exactly when you buy one lot how much it will cost. So in the case of Amazon, it's going to cost you this amount of money, US dollars, which is approximately 1.5 million Hong Kong, okay, or renminbi a little bit less. So quite often when the share price gets too high, you're going to price some retail investors out of the market. Not everybody has 1.5 million in cash in their pocket ready for deployment. You might, okay? Not everybody. So they try to split the stocks so that there are more people who can participate. Now, that implies that the stock price must have gone up a lot so that it becomes unaffordable. And that is sometimes regarded as good news. Plus the fact that there are a larger number of shares although that really shouldn't have any bearing at all, okay? But curiously enough, it does in real life, okay? So that's the stock split. Now, so Paul McGinn is actually, apart from detailing what should be the expected price change, which is adjustment from 30 cents to 10 cents, I think he gave you this sort of accounting treatment. So you cancel, so to speak, you cancel the original 1,000 shares, and then you replace that with 3,000 new shares with a lower par value. Okay, but that's just squaring the books. And then what about the possible market pricing effects? And if the share price does not drop to exactly 10 cents, then obviously you stand to make some profit. Okay, so that's all there is to it for this. This outcome will confer a wealth gain for all equity investors. Okay, so nothing tricky about that. And so this thing about par value is mostly an accounting concept, that when you create a stock on the day when it's born, when it's created, there is this thing called a par value that you enter. And actually in Hong Kong, I think they already abandoned that concept. So in Hong Kong, stocks do not have such a thing as par value. Now, so the second one is on what we call bonus issues or stock dividends. Okay, and the way this works is, so okay, let's just, I'll give you just 1 minute to read this. Okay. Okay, now the difference between a stock split and a so-called capitalization issue is that, so you gotta understand a little bit about how equity is accounted for. So at the very beginning, when you start a company, so you have assets and liabilities, and you have a bit of equity. Now over time, when your company starts to do well, you're going to make lots and lots of money. Okay, but as far as accounting is concerned, there is an account for this, and there is an account for, this is what's called share premium. Okay, now I'm not really the best person to have an extensive discussion on accounting. Plato is much better than me on that, okay, but I'll do what I can. But so this is the original par value. And when you do a stock split, what you do is let me use a different color. You try to split this part. Okay, first of all, out there in the market, when people look at your company, your stock price, which reflects your total company's valuation, has to be this one. Okay, it's just how you account for it, that's all. Okay, so this is your your company's value. Now, so when you do a what's called a capitalization issue, what you are doing effectively is you are not doing stock splits like this. Okay, you are adding by taking out some money from this box and then saying that part of this now becomes new shares that you issue. So that's capitalizing a part of it, capitalization. Okay, you see the difference? Yeah, but again, it does not create any economic value whatsoever. It's just taking some money from an account, take off the label, the share premium label, and then relabel it. So now your share premium account would look like this one at the bottom, okay? And then your paid in capital would be this one. So mostly this is an accounting discussion, at least these two paragraphs, okay? What are the pricing effects? Well, it depends on whether the price adjusts, you know, according to what you expect it to do. So in this case, there were 5,000 shares, and then it's $1 per share. So the company, the price should be $5,000, but then you are going to do a capitalization issue where there will be two new shares, okay, for everyone already issued. So now you've got you've got 15,000 shares sharing the same amount of money, okay? So the price will adjust accordingly. The pricing effect, well, if the stock price moves, of course, you're going to make money. Okay, so have a look at this. Reverse stock splits is just the opposite of what we had in example A, but now you are combining the stocks. So again, you know, from an accounting point of view, that all happens within this box here, okay? Reverse stock splits are probably not generally considered as good news, because that's usually when your stock price is quite low and you want to combine it to sort of dress it up, okay? So that's on stock splits. Now, I want to just share with you some notes on oversubscription. So you all know what oversubscription, you know what it means, right? That is when before the trading of in an IPO, when a company's stock is about to be listed. So before the big day, the IPO day, so there's a lot of activities going on, but all of these are well, offline to you know, I think that's the best word to describe it. Offline means you are taking, it's not online, your stock is not trading yet. So offline means the iBanks are calling investors, institutional investors, and also receiving subscriptions from retail people, okay? Some typing errors here. Via, okay, so institutional investors via an extensive network of brokerages and banks. Okay, now this process, before a stock even becomes tradable, is what we would call loosely the primary market. So the primary market isn't really a market as such. It's just a lot of people making a lot of phone calls in order to try to determine what is the interest in the market. Okay, and retail investors are basically price takers. Now, how are IPOs oversubscribed? Well, now for institutional investors, they can place an order for just exactly the amount they want to buy, but quite often I know that they don't. Okay, so maybe they want to buy 1 million shares. Okay, that's their target, but they would place an order for 500,000 with Morgan Stanley, 500,000 with JP Morgan, maybe 500,000 with HSBC, 500,000 with UBS. Now you're going to wonder, well, doesn't that mean that they run the risk of getting 2 million shares? It's true. Okay. The underlying assumption is because the stock is oversubscribed, if you are just going to put in whatever order that you want for 1 million shares, okay, you don't even get that. That's the underlying assumption. Now, it's funny because if everyone thinks like that, that is exactly what ends up happening, okay? So I can describe to you, for instance, next time you can experience this for yourself, okay? I'll relate to you my experience as a retail investor. So if you have, let's say Xiaomi, did anyone participate in this Xiaomi IPO as an investor? Okay, now, if you go into a bank where you can subscribe, it's very simple. You go into a bank, you can't miss it. There'll be a whole pile of prospectuses right in the middle of the bank lobby. You can take a copy and then read it and then put it in the recycle bin and whatever. Okay, but you fill in a form, okay, and you talk to the bank's investment officer, and they will ask you how many shares you want to subscribe. Okay, now, what was Xiaomi's IPO price? What was it? Does anyone know? Approximately. How do you spell Xiaomi? Xiaomi. Does anyone have a clue? 30. This one didn't go so well. Pricing at the bottom of the range. But what was the... Doesn't tell you. Okay, Xiaomi is selling about 2.18 billion shares at 17 Hong Kong dollars each. Okay, you see that? So you can pick up these, look at the size, the thickness of this, it's like a telephone book. So let's say you go to a bank and you are just a little guy and you tell them, oh, I want to buy 1,000 shares. 1,000 shares of Xiaomi, and they will tell you, okay, the price is somewhere between 17 and 20. Okay, so you would probably need to have around $20,000 in your account. Okay, and the way it works is when you fill in a form and you put in an application, which will be like 1 or 2 weeks prior to the IPO. Okay. At that moment in time, they would lock up your funds. They're going to lock up $20,000. They want to make sure that if they give you the stocks, there is money there. Okay, so you can't touch this. That's how it works. Let's say -7. And then, so if you say to them, well, I want to buy 1,000 shares, okay, they are likely to tell you well, this stock is really, really hot. And if you just subscribe 1,000 shares, you may just get 100. Let's say it is 10 times oversubscribed. Let's just say it is, okay? So the banking officer will encourage you to subscribe for more. And your reaction might be, yeah, but I don't want more, okay? I want my 1,000. And they would say something like, well, you subscribe for 10,000, you're going to get 1,000 anyway. You are only going to get 1,000. You know what I'm saying? Now, if everyone does that, that is exactly how you create an oversubscription. And I tell you, that happens a lot. So they would say, all right, well, this is what you want, but why don't you put in an oversubscription? And then you say, yeah, but I don't have $200,000. I don't have that kind of money. And the officer will say to you, well, don't worry. You probably will not end up buying that amount of stock. And we're going to lend you the other money that we will need to lock up. Okay, so we're going to lend you this amount of money, but it is unlikely that you will end up buying. But technically, as far as the contract is concerned, you have committed yourself to buy 10,000 shares. Are you with me? Just to give you an idea, so the way it would work is you've got the retail investor. Prior to the IPO, the retail investors would have to actually put some money in a deposit account. So maybe let's say that the investor puts $20,000, as I said, okay, and then the bank, and then they will sign a contract, a subscription with the bank, and then the bank will borrow from somewhere, from the street. The bank will borrow the other $180,000 and put that into the same deposit account for about a week. Okay. Now I'll give you an idea which of what can happen. And a few years ago, there was an IPO with who was it? Country Garden. Okay, and I remember this case. So they raised the equity that they raised was around $13 billion. I think it was US dollars. That was the big one at the time. Now, this deal was 250 times oversubscribed. Now, that's pretty serious. Okay, so you imagine the funds that they could have locked up if you multiply the equity that they were planning to raise by the amount of oversubscription. And it's a huge number. Now, the interest margin means just this. You're going to borrow the money and you are going to lend it. So you lend it indirectly to the retail investor, $180,000, and they have to put that, so the funds are borrowed and then locked up. Now, of course, when they borrow this money from you, they have to pay an interest. Now, it's very, very low, and it's only for 1 week, so they practically don't notice it. But let's say you borrow at 0.5%, because interest rates are low. Now, when you lend the money to the retail investor, you're not going to lend it to them at 0.5%. you might lend it at, let's say, 1.5%. They don't notice it because you're going to lend $180,000 for 1.5%, but it's only for 1 week. So if you are a retail guy, because the money is so little for 1 week, 1.5%. Okay, so what does that amount to? So $52. Can barely get a cup of coffee at Starbucks. And then if you're a retail guy, you say, okay, never mind, yeah, $50, I can handle that. But when you have huge amounts like this, and then your interest margin, let's just say 1%, is probably wider than 1%, but I'll take 1%, okay? 1% is when you borrow at 0.5% and you lend at 1.5%. So 1% for 1 day on this amount of money would be around $90 million Hong Kong, 1 day, okay? Now that's the kind of money we're talking about. Are you with me? Yeah? So I think the banks are pretty happy doing that. And the issuer doesn't mind because it makes the IPO, it makes it look good. But there are some potential problems on the back of that. Okay. Anyway, I just thought I'll share with you on this. Now, another thing I want to sort of impress upon you is on the topic of cornerstone investors. Do you all know what they what they are, right? So what are cornerstone? Can anyone tell me what cornerstone investors are? Thank you. So these are actually my words. This is how I would answer the question. Someone that would ask me in an interview. And so you have a guaranteed allocation. It's normally a pretty big one. So you are rich and famous, hopefully as an investor, not a movie star. And then you promise to participate in the IPO. Not only that, you promise that you're not going to sell out, and then they will give you a big chunk of it. Okay. Now, please note that this is not a global feature. Did you know that? Did you know that? This is only in Hong Kong. Okay. This doesn't happen in New York. Doesn't happen in London. Does it happen in Shanghai or Shenzhen? Do they have this? You should know things like that. And one day soon, you know better than me. Okay, but does this happen in Shanghai or Shenzhen? You should try and find out. Huh? But in Hong Kong, the idea of cornerstone investor is a tradition that goes very deep. It's been there for quite some time now. How is that going to help? Of course, when there is some guy that everyone knows, it is supposed to boost confidence. Ma Yun, or the Emirates Sovereign Fund or whatever. Okay, and it would make a very noticeable contribution to the demand side, and it relieves some kind of pressure. Okay, so there's some good things you can say on that, but if you would ask the question, is that actually a good thing? I think to some degree, yes, it is, but it actually brings what I call a new set of problems. Because you think about it, when companies do IPOs, so obviously you care about the price if you are an issuer. You care about where the IPO actually started trading, the first price. But you care about your investor base. You care about where they came from. I mean geographically. You care about what are their backgrounds. Are they hedge funds? Are they mutual funds? Are they sovereign wealth funds? Because different types of investors, they have different behavior. If it's a hedge fund, you don't know how long they're going to be there for, maybe 1 week. If it's a sovereign wealth fund, they might be there for longer, for example. You care about the institutional versus the retail, the split. And finally, last but not least, you care about the granularity. I can't think of a better word now. What I mean by that, granular, GRANULAR, granular. That means if I was an issuer and I issue some stocks, so this is my equity base, and this is what an issuer should care. Now situation A is, so this is my equity for IPO. Situation A is I just have one or a couple of big investors, cornerstone investors, and then I got some little ones. Now situation B is, so scenario B is I don't have these cornerstone investors, but I have lots and lots. I have a very diversified base of investments from institutions. Which one do you think is better? Maybe you think they don't care. They do care, because it's not just simply, oh, the money is in the door, see you later. No, it's not that simple. Because don't forget, shareholders today they can buy, tomorrow they can sell. Which one do you think is better? A. Why would you prefer A? I can't say you are wrong. To some degree, what you just said actually is valid. But after the IPO is done, so generally when a company doesn't have a diversified, so if you think in terms of just how many persons, can be shareholders here, you might be looking at, let's say, 500. So 488 here plus these two. Whereas here, you could be looking at 5,000. Now, the problems that come with this, problem number one is that if these two guys, if they don't trade or they don't sell, and they're not supposed to, then the amount of stocks that will end up trading actually are substantially less. So it's just this bunch of people here playing amongst themselves. But if you have, now don't forget, here, even if you don't have the cornerstone investors, you can still have substantial shareholders. It's just that instead of somebody owning like 15%, and then maybe someone owning 18%, you will have more investors, and some of them will own like 1%, 2%, which is still a significant amount. Okay, you are likely to find stocks trading much more actively when there are just more people participating. And in fact, you don't have to take my word for it. Okay, now I'll show you some examples. The one that I remember very clearly was an IPO that happened around 2 years ago. This one was PSBC, okay, Postal Savings Bank of China. And I'm happy to load up this article. Now, this time, the banks, okay, read the headline. So the bank's 6 cornerstone investors have subscribed around 75% of the planned H shares set on Wednesday at an offer price of $4.76. Now, that to me is just way too much, okay? It means that 3/4 of the IPO actually would not trade, or at least for the first 6 months, nothing will happen to those stocks. Now, critics say that large investments by cornerstone investors may push up the offer price and hurt liquidity. Now, I don't know about the first claim, but the second claim is certainly valid, okay? It's going to hurt liquidity because as the stock is locked up for a minimum of 6 months, okay, leaving few remaining shares tradable during the period. And the cornerstone money can also pressure the stock as the expiration of the lockup period nears, and people may want to sell out near that 6-month point. Now, you don't have to take my word for it, but as far back as 2015, okay, so now we go back one year more. So this is an article from the Financial Times. Hong Kong's cornerstone investors, so that is a Hong Kong phenomenon, do not guarantee IPO success. Okay. Problems for investors when list becomes one of quantity rather than quality. What does that mean? Okay. In Hong Kong, there is an art to looking at term sheets for an IPO. It doesn't involve simply multiplying the shares by the price. The first thing an investor will look at is a list of cornerstone investors to see who is and who is not actually there. Okay, much like you go to a party, you want to know who's coming to the party. And in the last 5 years, the presence of these investors has become so ubiquitous. That means they are everywhere, okay? That the cornerstone investors, or who you have there, can say as much about a deal as the official marketing. Now, they're not unique in Hong Kong, but they are not everywhere, okay? So don't think that every stock market has that. It might be good for you to check what they actually do in China, okay? So there's been, now this was 3 years ago, okay? So for that year, this was October 2000, so roughly 3 years ago. And by that time, so cornerstones in that year bought 38% of all the equities sold in Hong Kong, okay? And So they're saying that if you have cornerstone investors and there's a list with big names, that's one thing, okay? People like Pony Ma, or this is a hedge fund, or big Asian insurers, they all signed up before, but other lists can include so-called friends and families, which typically turn, and they can be obscure and you don't know where they came from, okay? So you can make up your own mind. I'm not asking that you must agree with me, okay? So that was 3 years ago, and then I showed you that piece on the Postal Savings Bank. Now, so fast forward a little bit to this year. Here is another piece of news. This time it's from Reuters, okay? So China would be wise to limit cornerstone investors. This is just an opinion from that guy. This was May this year, okay? The practice can prevent wild stock swings, but also distort markets, okay? I think the conclusion you come to is that it can be a good idea sometimes, but if you have too many, and in that case with the Postal Savings Bank, that to me was an extreme. I don't know if there's been another one higher than that, but having cornerstone investors buy 75%, for one thing, it means that the so-called global coordinators or the IBanks, they don't have to do much. Their job is to go out there and call up institutional clients, okay, not cornerstone, institutional, and there are a lot of institutional clients with a lot of money, okay, don't forget that. Institutional fund managers, insurance companies, sovereign wealth funds, they have money, okay. It could just be institutional investors, they have money, but for some reason they're not interested. So you have to call up the cornerstone investors to rescue you. That is one possibility, and that's probably something we don't want to see. Okay? Is everyone okay with that? So if you have an IPO and it's $10 billion and $7.5 billion is already placed, you don't really need the IBanks. You're going to wonder, well, why do I need you? You're going to 75% of the phone calls that you needed to make, now you don't need to make anymore. And then there's also the liquidity problem. Okay. Now, the other thing I would just quickly run by you is this concept of what we call weighted voting rights. Okay. Now, I'll just briefly explain to you what that is. Okay. Now, so typically, when companies issue shares, you are supposed to have equal voting rights. So if you have one share, you have one vote. It's very fair, okay? If you own 10% of the shares, you have 10% of the votes. And this changed when some companies, and I suspect the tradition started in the United States, started issuing shares. They call them dual class structures. Sometimes not even dual class. Dual class means there are only two classes. In the case of Google, for example, I think there are three classes. There's class one is one vote has one share. Sorry, one share has one vote. Class B is one share has 10 votes. And class C has no votes at all. Okay. Now, so they did that. And a share which has WVR attached to it, okay? Now, you share the same profit or loss, so that doesn't change. So if you have 10 times the voting rights, it doesn't mean that one share gets 10 times the profit, okay? So the profit, the loss, the risk, the benefits, they are the same. It's just when you need to vote on something, some shares have a bigger, voting weight. And for a long time, I think the regulators in Hong Kong, they were sort of agonizing over this. You know that word? Agonizing. You know agony, right? This is the verb for agony. So they were deliberating on whether they should do this or not, and I think a lot of people were very, very hesitating. They were hesitant. Now, Hong Kong traditionally has always been a one vote, one share system for a long, long time, and I think that goes to the, the core value of, the Hong Kong equity platform. And I'll tell you why there are problems in Hong Kong. So as a result, indirectly, this was the key reason we missed out on Alibaba. At that time, Alibaba had a rather strange ownership structure, which would not be permitted in Hong Kong with the regulations that existed at that time. Okay. Now, first of all, okay, let me show you what companies actually have this dual class. Okay, this is a list of companies in the United States where they have this so-called dual class. Now, Alphabet is the short name for Google, so they actually have three classes, as you can see. So dual class doesn't mean just two, but Class A has only one vote. Class B, one share will have 10 votes. You might think, or you might be curious, how do their stock prices actually trade? So for Google, there is GOOG stock code. There is GOOGL. I think that one is the one which has the a different voting. One is not going to trade 10 times the other one. Okay, it's because you share the profit and the loss on a per share basis. But you can see there are 19 pages if you look at the top right hand corner. So quite a lot of companies in the US, they do actually do that. And then, of course, there are Chinese companies who have gone to the US to list in that country. Now, they kind of started this practice, and as a result, other stock markets, including Hong Kong and Singapore, and I don't know about London, but certainly Hong Kong and Singapore, they are feeling the competitive pressure to do something similar. Okay, before we never did that. Okay, now there are very interesting and important practical and philosophical issues related, I think, to WVR, and I'll try to just spend 5 minutes and share with you what some of these might be. This could well come up, I think, in an interview. Even if it doesn't, you can start talking about it. Okay, what are the problems? First of all, the regulatory environment in Hong Kong is different to the United States. Okay, United States, the stock market is governed by or regulated by the SEC, Securities Exchange Commission. That is the body that recently tried to challenge Tesla and Elon Musk, and actually they won, because they are very, very powerful. Okay, now in Hong Kong, the equivalent is the SFC, Securities Futures and Futures Commission, SFC. They don't have the same amount of power, okay, and they have to work with the Hong Kong Exchange, HKEX, which has, I think, to some degree, a conflict of interest in there, because they are, partly a regulator, but they also have to make money. Okay, so the regulatory environment here is different. Now, Hong Kong is not a litigation culture. And what I mean by that is in the US, it's actually a lot easier to sue someone, take them to court, than it is in Hong Kong. And the regulatory philosophy of Hong Kong also is quite different. And what I mean by that is, loosely speaking, in the United States, the disclosure requirements actually are quite tough, and you have to disclose a lot of information about your company and your business to investors, far more than you would in Hong Kong, quite possibly. But after you disclose all the information, it is up to the investor to make a decision whether they want to buy or not. Now, the philosophy of Hong Kong is something like the disclosure requirements may be less, okay, it's still a lot, but relative to the US. But the regulators actually, they take more care in saying, you can't do this, you shouldn't do that, okay, you shouldn't do this, you must have a 25% float, and so on and so forth. So a lot of these do not really apply in the US. So they give you all the info, and then it's up to you, okay? Hong Kong is not like that. And it's harder to short sell in Hong Kong. Okay, in the US, most stocks can be short sold. Now, for all these reasons, you cannot take a finance practice in another market and just kind of do a copy and paste and bring it over here. Now, I'll tell you what I mean by Hong Kong is not a litigation culture. So in the US, if you want to file a complaint against the company, so first of all, the way it works over there is, if you think you have a case and you want to sue someone, but you don't have the money, you can go to a lawyer and they'll talk to you. And if they think you have a very high chance of winning, they will take on your case, and they will ask, okay, if we win, okay, and you get some compensation, would you mind to share with me? Let's say I get 25%, okay, but if we lose, no problem, okay, you just walk away. So that's the system they have over there. Now, you can even have what are called class actions. Have you heard of that term before? It's not the students in a class forming a group to try to sue the lecturer, okay? Class action is a tradition that started there in the United States. So let's say, and it happens quite frequently when there are a bunch of individuals who feel that they have become victims of certain corporate action, okay? So you buy some kind of health drink and you drink it, and then it turns out to be harmful. Now, the problem is, if you take on that company, first of all, you don't have the financial resources, okay? Number one. Number two, in that case, even if you go to the lawyer will think, well, if it's just one case, and if they agree to compensate you, all right, maybe you get $1 million. But even if you were to share that with me 50-50, I only get $500,000, which is, so for one case is not really a lot of money. So what you can do is you go to a lawyer and you tell them, okay, I would like you to help me file a class action. That means the lawyer will take your case, sue the company, and anyone who is in a similar position, if they want to join, they can join for free. Now, this is especially useful, you can imagine, if you are a shareholder, and there are thousands of shareholders out there. You know, it's funny. So I have a couple of stock trading accounts, and I sometimes buy stocks of US companies, and sometimes I get a package in the post telling me that somebody has filed a class action against this company, and you were a shareholder in 2014, and at that time they violated some kind of rule. The Elon Musk case is the best example. So would you like to join the class action? Okay, I never bother, because the amount I was investing was so small, number one, and number two, I would have to find all my statements to prove that I was a shareholder at that time. Just forget it, okay? But you can, okay? So now, Hong Kong doesn't have this mechanism. So for all these reasons, I think it can be. So I think they feel that they don't have a choice in the Hong Kong market, and now they are following, but they say that weighted voting rights would be restricted for IPO of companies that are innovative. What the hell does that mean? How do you even define innovation? So if I'm in the funeral business, I'm not innovative. Okay, so that is a little bit ambiguous. Okay, I don't mind to share with you. So I have here. Here is another document I found. Is called "How to Organize a Class Action Lawsuit." Okay, so part one, you begin to organize it. So what do you want to do? And you research for other possible plaintiffs. Plaintiff is a word for, so you are suing somebody, you are a plaintiff. So the guy you are suing is called a defendant. So other plaintiffs, if you took some medicine, let's say from Pfizer, okay, and then turns out to be harmful, then you want to look for, okay, who else took that medicine? If you are a shareholder, that's quite simple. You just think, okay, how many other shareholders are there? And then the four prerequisites for class action, okay? The class must be so numerous that it would not be practical to conduct separate cases. There are just too many people out there. The legal issues must be common to all the people who want to sue, and at least one individual has a case which represents a typical claim for everybody else, okay, and then one individual can represent the interest of all other ones. Now, the shareholder or abusing shareholders' interest is I think, the perfect scenario for something like this, okay? So you plan the class action lawsuit, you find an attorney, decide whether to file a case or whether to become the lead plaintiff, and so on and so forth. Okay. Now, none of this you can do in Hong Kong. Okay. So we have had. I mean, all right, they do it over there. Good for them. But like I said to you, because of the different, the litigation tradition, and because of the different disclosure requirements, okay, I think it may be suitable for them. And you can see even Berkshire Hathaway. You see that? The problem is, okay, now there's a Warren Buffett, but what if one day after he's gone, okay, are you going to find a second Warren Buffett? Okay. All right. Now, what I'm interested to do is I want to take a second vote. All right. And I want to take a second vote on the second question, or maybe the first question too. First question: do you think weighted voting rights is good for stock issuers? Okay, issuers. You want to vote on that? Use question banked. Yes or no? What is your answer? So it's still the same session if you haven't logged out. So just tell me what you think. So of course I didn't mention before, from an issuer's point of view, from the point of view of someone who controls a company, what is the point of WVR? Well, the point is you can still retain control even if you are not the majority shareholder. Okay, somehow that doesn't seem to be right. And I think a lot of people in Hong Kong financial circles, they feel the same, but they feel they don't have a choice because you're going to keep losing out to New York unless you make some changes. Okay, this is a feeling I get from talking to people in the market. All right, I'm going to call a vote here because we're running out of time. Okay, I think it will still be majority. Okay, yeah, majority still think it's good for the issuer. Now, actually, what I'm really interested in is how you vote for question number 2. Do you think WVR is good for the investor? What is your answer to that? The investor. The other people have given up. I'll give you time to vote on this. After you cast your vote, then I'll let you go. Okay. Anybody else? All right, let's have a look. Okay. Well, like I said, you don't have to agree with me, but seems like I managed to change your mind. That was not my intention. I just share with you how I feel about it. Okay, whether you think it's a good idea or a bad idea, I just want you to have, or you should have an opinion on this topic. Okay, you should have an opinion, and you should have an opinion. You should have an informed opinion of what the issues are and why they do it in the United States and why they can do it over there, and why when we do it here, there are issues that could create a challenge for just trying to copy and paste something that has worked elsewhere. Okay. Okay, so I want to thank you for coming, and I'm going to stop here. And if you have not signed in at the start, I'll give you a chance to do so. Now, the next time we meet, so like I was saying to those who might have come in a little bit late, next week, quite possibly, I will start the session at 6 p.m. if possible. Okay, but I will let you know. I will send you. The date hasn't changed. It's just I might do it half an hour earlier on October the 8th. I'll let you know. And I thank you for understanding. Okay, I have an evening appointment that I need to attend. All right. Thank you, everyone, and I wish you a very good day ahead.